This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
They often call it the perfect financial vehicle, don't they? Tax-free growth, market return potential, permanent life insurance, all wrapped up in one neat package.
Exactly. We're talking about Indexed Universal Life, or IULs.
But what if that shiny sales pitch, the one focusing on all the good stuff, is really only half the picture?
And that second half, well, that's often where the reality of the costs, the limitations, it really changes things. You know, when something sounds that good in finance,
You got to look closer.
you really do.
Welcome to Invest Education Hub. We're here to guide you on this deep dive, turning that financial complexity into, well, clarity.
Our mission today, cut through that marketing noise around IULs.
We want to uncover how they really work, talk about what agents might leave out.
And explain why knowing the difference could save you a lot of time and money down the road.
Okay, so let's dive in. What exactly is an IUL?
Right. So at its core, it's a type of permanent life insurance. Universal life, they call it. Flexible premiums, adjustable death benefits sometimes.
And the indexed part. That's the hook, isn't it? The growth engine.
That's the hook. When you pay your premium, say monthly, that money gets split. Think of it like two buckets.
Okay, bucket one.
Bucket one pays for the actual life insurance, the death benefit coverage, pure cost of insurance.
Makes sense. Bucket two.
That's the cash value component. This is what's pitched as your investment part.
And it's tied to a market index, like the S&P 500.
Usually, yes. Typically the S&P 500. But here's the really crucial point, the first big catch. You are not actually investing in the S&P 500. You don't own any stocks or index funds.
Wait, so if I'm not owning the assets, how does my cash value track the index? How does that work?
The insurance company, they use financial instruments, usually option contracts. It's a way for them to mirror the index's performance, sort of synthetically.
Without taking on all the direct market risks themselves.
Exactly. And because they're managing risk this way, using options, it introduces built-in limits. These protect the insurer.
Limits like the cap rate. I hear about that one. So if the market has a huge year, say up 20%,
Right, a fantastic year. But your policy, it might only get credited with, say, 8%, maybe 10% if it's a generous cap.
so there's a ceiling on my gains no matter how high the index goes.
Precisely. Your growth is capped.
And the flip side is the floor rate. Agents love talking about the 0% floor. It can't lose money when the market crashes.
That 0% floor is definitely the main selling point. And it's true, if the market tanks, say down 15%, your cash value account is credited 0% for that period. You don't technically lose value in that year due to market drops.
Seems good on the surface.
It does, but think about the trade-off. You're giving up potentially huge gains, like that 20% we mentioned.
Which you'd eventually recover from in a direct index fund anyway, usually.
Right. You're sacrificing major upside, that real compounding power, just to avoid temporary downturns. Limited upside, basically.
Limited upside, but definitely not limited fees.
Ah, now we're getting to it.
This brings us to what many see as the core issue, the cost of insurance, COI. Why is this such a silent killer for returns?
Because that COI, the cost for bucket number one, the death benefit, it's not level. It's typically based on something called annual renewable term. RT, annual renewable term.
This is key. It's a detail often glossed over. We all know, statistically.
The older you get, the higher your mortality risk.
Right. So the actual cost to insure your life goes up every single year.
So inside the IUL, that insurance part gets more expensive each year you hold the policy, even if my premium payment stays the same.
Exactly. Think about it like a mortgage, but in reverse. With a mortgage, your payment might be fixed, but over time, less goes to interest, more goes to principal.
Right. You build equity faster later on.
But with an IUL and that rising RT cost, it's the opposite. The insurance cost is like the interest in this analogy.
So as years go by,
More and more of your fixed premium gets eaten up just paying for that increasingly expensive art insurance.
leaving less and less to actually go into bucket two, the cash value investment part.
Precisely. The investment potential gets squeezed year after year. And what happens if you keep the policy for a really long time, into your, say, 70s or 80s? That COI must get enormous.
It can become massive, and that leads to what's called the upside down risk.
Upside down.
How so? The internal COI can eventually become higher than your planned premium payment.
Oh, wow. So my $500 a month isn't enough anymore.
Exactly. And at that point, the policy has to get the money somewhere to pay that insurance cost and keep itself alive. So it starts automatically pulling from
The cash value, the money I thought I was saving.
Yes, it starts liquidating your accumulated cash value just to cover its own internal costs. Your investment starts cannibalizing itself just to keep the death benefit in force.
That's staggering. That completely undermines the whole idea of long-term saving.
It's a serious long-term risk that many people are unaware of when they sign up.
Now, I know agents sometimes mention configurations, things like option A versus option B. Can't they, set up the policy smartly to avoid this RT problem getting out of control?
That's a really important point and something the sources touch on. Yes, there are configurations. Option A is typically a level death benefit. Option B aims to pay at the death benefit plus the cash value.
So option B sounds better? Maybe.
It sounds better in terms of payout, but it doesn't eliminate the rising RT cost. To make option B work, to have enough cash value to potentially pay out and cover those ever-increasing insurance costs.
The premiums have to be much higher from the start, right?
Significantly higher, often making it unaffordable or just plain inefficient for the average person trying to save. And honestly, the reality is many agents are trained primarily on the sale.
Not necessarily on the complex long-term actuarial math of that rising RT.
Correct. They might not fully grasp or explain the impact decades down the line. So even with configurations, the fundamental structure, that annual cost increase, remains a major challenge.
Okay, let's ground this in numbers. After you account for the caps, the fees, the COI squeeze, what's a realistic historical return people actually see in an IUL average year?
Well, after everything is factored in, historically, maybe 4% to 6% per year. If it's managed well and the caps aren't too restrictive in a given period.
4 to 6%. And a simple, boring, low-cost S&P 500 index fund over those same long periods.
Historically, you're looking at 9% to 11% annually on average.
Wow. The difference between, say, 5% and 10% compounded over 20, 30 years is...
It's enormous. It's the difference between hitting your goals comfortably and potentially running out of money. It's the power of compounding being seriously hampered.
But, okay, even putting the slower growth aside for a second, there's another detail that seems to shock people when they find out. The death benefit payout. Let's talk about the death benefit myth.
This is probably one of the most misunderstood parts, especially with the common option A policy structure.
Which is the default, usually.
Often, yes. Under option A, when the policyholder passes away, the beneficiaries typically receive only the stated death benefit amount, the face value.
And the cash value, the money built up inside over decades.
The insurance company generally keeps the cash value.
Wait, hang on. So if I have a $300,000 policy and I diligently saved and built up, say, $50,000 in cash value inside it, when I die, my family gets the $300,000 and the insurance company keeps my $50,000, my savings.
That's typically how option A works, yes.
Yeah.
The cash value is essentially used by the insurer to help offset their payout of the death benefit. You've effectively been pre-funding part of your own death benefit payout with savings that then disappear for your beneficiaries.
That feels counterintuitive, to say the least.
It's definitely not what most people assume is happening.
So if the structure has these serious drags on growth, and the death benefit works like that, why are IULs pushed so heavily? Why are they everywhere?
Well, the bottom line often comes down to sales incentives.
Commissions.
Very high commissions, often. Agents can earn thousands of dollars up front for selling an IUL policy, much more than, say, for recommending a simple term policy and an index fund.
So that big payout incentivizes focusing the pitch on the positives.
Naturally. You focus on tax-free growth, the 0% floor, lifetime protection.
And you kind of minimize or skip over the rising costs, the caps. What happens to the cash value at death?
Exactly. And the complexity itself becomes a sort of sales tool.
How so?
Oh, it's complicated, lots of moving parts, but trust me, it's good for you. It's tax advantaged.
And that, just trust me, on something complex should be a huge red flag, shouldn't it?
Absolutely. Anytime you're discouraged from fully understanding a major financial decision, you have to pause and ask who really benefits from that lack of clarity.
Okay, now, let's be fair. We aim for impartiality here. Are there any situations where an IUL might actually be a suitable tool?
Yes. To be completely balanced, they can serve a purpose in very specific, narrow circumstances.
Sidecast.
Primarily for very high-income earners. People who have already maxed out all their other tax-advantaged savings options, their 401ks, Roth IRAs, HSAs, everything.
So they need another place for tax-deferred growth.
Right, and potentially tax-free access later via policy loans. It can also be used in complex estate planning strategies.
But crucially, who should be managing this kind of strategy?
It really should be a fee-only fiduciary financial planner, someone legally obligated to act in your best interest who isn't earning a massive commission from the sale itself.
Not the person primarily incentivized by that upfront payout.
Correct. So our stance isn't that IULs are inherently bad, but for the vast majority of people listening who are focused on building wealth efficiently.
We generally don't recommend it as your primary investment vehicle.
No, the costs and limitations usually outweigh the benefits compared to more direct approaches.
So if someone needs life insurance protection and wants investment growth, what's the clear, transparent alternative? The one that usually comes out ahead.
It's the classic time-tested strategy. Buy term life insurance and invest the difference.
Let's use that $500 per month premium example again.
Okay, so you have $500 a month budgeted. Instead of putting it all into an IUL.
Step 1, buy term life.
Exactly. You could probably get a substantial 20-year or 30-year term life policy, maybe $300,000 or $500,000 of coverage, depending on your age and health, for maybe $30, $50 a month, pure protection, locked-in cost.
Okay, so let's say $30 a month for $300 K coverage. That leaves $470 from the original $500.
Right. Step 2, invest that remaining $470 every month into a straightforward, low-cost index fund, like an S&P 500 ETF or mutual fund.
In your own brokerage account. Fully transparent, fully liquid.
Exactly. You control it completely.
Now let's compare outcomes. Say after 5 years, assuming average market returns.
Well, you've paid roughly the same amount into the system in total premiums contributions, but that $470 month invested at, say, an average 9% market return.
We grow to maybe $35,000, $40,000?
Yeah, something in that range, yes. And that money is yours. No internal fees eating away at it in the same way, no caps limiting the growth.
And crucially, what happens if you pass away during that term?
Your family gets the full $300,000 death benefit from the term policy,
Plus
the entire value of your separate investment account. The full $40,000 or whatever it's grown to, they get both.
So the protection is there, the investment growth is uncapped and directly yours, and the family receives everything.
That's the power of keeping things separate, transparent, and low cost. It's about clarity and consistency in building wealth.
It really brings it home. Indexed universal life, it sounds sophisticated, maybe even cutting edge.
But when you unpack the math, the structure with those caps limiting your gains and those rising internal insurance costs eating away at your capital, it often ends up benefiting the agent and the insurance company much more than the actual investor trying to grow their money.
Wealth building. At the end of the day, it's usually simpler than these complex products suggest. Clarity, patience, consistency.
Not chasing complexity that sounds too good to be true.
Because that financial power really comes from understanding what you own, not from confusion. An IUL isn't necessarily a scam, but it's rarely the optimal path for your main investment growth.
Question the complexity. Always.
And maybe reflect on this thought. Look at the skyline of any major city. Those huge towers, the bank headquarters, the life insurance companies, skyscrapers. They weren't built with inherited money.
They were built on the small margins, the fees, the spreads, derived from millions of consumer financial products over decades.
So if a financial product is presented as so intricate, so complex, that you're basically told, look, just trust me on this one, you really have to ask yourself,
are you truly being served here?
or are you just helping someone else build their tower? Always seek to understand before you commit your hard-earned capital.